Okay, so you have an IRA, or maybe you're thinking about opening one, and it's 2016, so you want to know what the 2016 rules are. Well, you're in good hands. At Jazz Wealth, we're in the business of managing investments, not charging for financial advice. That means the advice is free. All right, so a traditional IRA is an investment vehicle that allows you to save and invest for retirement. Now, you do this by deferring taxes until you get to retirement. Now, contributions, they're said to be made pre-tax. When you hit retirement, you'll pay the taxes on any of those contributions, along with any gains that you may have had along the way. This type of account is usually set up by someone who wants to defer those taxes until retirement, when they feel that they'll be in a lower tax bracket, or maybe that taxes will just be lower. Now, as with a Roth IRA, there are some specific rules that you need to know, but never fear, we speak plain English here at Jazz, so let's get started. All right, the first thing, we want to check that you're even eligible to open or contribute to an IRA. There's a few rules. Now, according to the IRS, for 2016, you can contribute if you or your spouse, if you're filing jointly, have some kind of taxable or earned income, but not after you're age 70 and a half or older, not allowed. Now, taxable income can come from a number of different sources. It's usually a salary, hourly wages, maybe profits from a small business, but the IRS is very clear about what doesn't count as taxable or earned income. For example, earnings and profits from rental property doesn't count. Pensions or annuity income also would not be counted. Now, if you have more questions about this, feel free to contact me directly. Always happy to help. Okay, now that that's out of the way, let's talk about how much you can contribute. Now, for traditional IRAs, the limits are actually the same as Roth IRAs. You can contribute up to $5,500 in a year, or up to $6,500 if you're already over the age of 50. That's what's known as a catch-up allowance. Now, these contributions can be made at any point throughout the year and in any increment that you want. You can even make the contributions all the way up to tax time. So for 2016, you could make a contribution anytime from January 1st, 2016, all the way up to April 17th of 2017. Now, remember that we said these contributions are made pre-tax, or sometimes you might hear people say that they're tax-deductible contributions. Well, this is true, but there are some limitations. Now, if you or your spouse, if you're married, have a retirement plan at work as well as a traditional IRA, your deduction may be limited. Also, your deductions may be limited if your income exceeds certain levels. But remember, we're here to help if you have any questions. Just give a call. Now, if you don't have a retirement plan at work, then your contribution should be fully deductible. All right. Now, let's say you've been contributing all these years and you've reached retirement age, or you're just ready to withdraw that funds from your account. Surely that can't be all that complicated, right? Well, it's actually not so bad, but you do have to follow some rules. All right. Any and all deductible contributions that you've made over the years, along with any of the earnings, are of course taxable when you withdraw them. So if you're under the age of 59 and a half, little side note here, you will have to pay an additional 10% tax penalty for withdrawing early. Now, there's a few exceptions to this. Maybe you're a first-time home buyer, or you decided to go back to college. Those are a few of the exceptions, but in any case, the IRS is very, very particular about how you go about withdrawing those funds. Now, in a Roth IRA, the original owner of a Roth is never ever required to start taking distributions, but a traditional IRA forces you to take distributions. In a traditional IRA, you must start taking distributions by April 1st, following the year in which you turn 70 and a half, and then by December 31st of each year after. Basically, when you turn 70 and a half, start taking money out of your traditional IRA, or the IRS is going to do it for you. All right, so there you have it. Now you know some of the basics of traditional IRAs, specifically for 2016. If this is a little overwhelming, or if you just have more questions, feel free to contact us. At Jazz, we're here to help you in every step of your financial journey. Unlike the old school advisors that make money by selling you commission-based products, our business model is to put the client first and we only grow when you grow. We'll give you every possible tool to help you grow along the way. The best part is that you get to keep your account in your name, and we never, ever, ever have access to your hard-earned income.